Hello and welcome back to Principles of Accounting 2. I'm your host, Dr. B. Today we're going to be talking about evaluating decentralized operations. As we explore the chapter, the way to best think about decentralized operations is consider a department store or a manufacturing company that has multiple departments. And within those departments, each department manager has the ability to make decisions. Let's go ahead and explore the concept. In a centralized organization, all decisions are made at the top level. An example of that would be a large corporation that dictates everything that happens to the lower levels of management from the top. So the CEO would make the decisions and tell the board of directors what to do. The board of directors would then tell the managers what to do. The managers would tell the employees what to do, right? That's a centralized organization. All the decisions made at the top levels. And there's really no bottom-up type of approach with a centralized organization. Everything comes down to the top. Small businesses could fit in that situation as well, where the owner of the business makes the decisions and the employees simply do what the owner says. That's the concept of a centralized organization. From an accounting perspective, in a centralized organization, all of the accounting operations are done in one office. In a decentralized organization, the top management does not make the decisions. However, they delegate the decision-making process. What that means is, in a decentralized organization, individual managers within departments or divisions make the relative decisions for their departments or divisions, and they, in turn, facilitate the decision-making process to top-level management. A way to think about a decentralized organization is through a department store where there are multiple departments and each department manager has the ability to make decisions and facilitate those decisions made at the top level. I like to consider the decentralized organization as more of a philosophy where the individual managers work together in a cooperative way, whereas in a centralized organization, everything's driven from the top down. So some good and some bad when it comes to decentralized operations. For larger companies, uh, decentralized operations becomes difficult because of the communication between upper management or the CEO level to the manager level. The the um, the CEO does not necessarily know what's happening on a day-to-day basis. The operational managers do. So for large companies, it's difficult at the top levels in a decentralized organization. It's also difficult for large companies when it comes to understanding the product lines and services from an expertise perspective. What does that mean? The CEO will know a lot less about the customers than the department manager would. The department manager is closer to the customer, right? So that is a disadvantage for a large company from a decentralized level or decentralized organization. The frontline staff, as they say, the department managers, the employees that interact with the customers, they have the ear to the ground, right? They have the expertise in the product line and services. And because of that, for a large company, the decentralized operation, it's difficult, right? So what typically happens for a large organization at the top level is they will delegate to the managerial level to allow managers, department or division managers, to make decisions for the operations because they are experts and they're closest to the customer. Decentralized operations is, I couldn't say this enough because this is very true. If you have ever worked in a department store or an organization where there are individual departments, you get really good training for managers of those individual departments. Also for the even for the employees, the career ladders are definitely there. So really good training in decentralized operations for department managers. They can enhance their skill set because they're able to make decisions. It's just a lot better in terms of if you compare a centralized versus a decentralized organization. Decentralized is just a lot better because the individual department managers have the ability to make decisions. They work closely with the customers, and the overall day-to-day operations of the business are much, much better than a decentralized operation. Some negatives, though, if you think about an organization that has multiple departments and multiple department managers, sometimes there's overlap. Well, what I mean by overlap is you could have two individual department managers making the same exact decisions. And what that does is it creates duplication for assets and expenses because they're making the same decisions. For example, you have a department manager that is making purchases and is utilizing staff, and you have another department manager doing the same thing. What that does is it causes duplication. And sometimes that duplication may not be necessary, especially if you have the ability to cross-train staff. So that is a disadvantage of a decentralized organization. And another one is if you have that type of duplication, it also has a negative impact on the company's profits because the managers of the respective departments are making decisions that do not consider the entire organization. This like just kind of recaps what we just talked about, but so yeah, a lot of advantages. Overall, I think a decentralized organization is probably much more effective than a centralized one. But of course, there are some disadvantages that have an impact on the company's profits, and that could be somewhat problematic over time. Another way to think about the difference between the two is think of a not magnifying glass. Think of the approach where you're looking at a picture, right? The further you stand back away from the picture, you can see, the whole picture, right? You see the whole picture. If you stand closer to that picture, closer, 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 you can see the detail within the picture, but you no longer see the whole picture. Do you see what I'm saying? So further back, way back you are, that's centralized, decentralized, you're seeing the detail. And when you're seeing too much detail, you're not seeing the whole picture. And therefore, if you don't see the whole company, you're only seeing your department, you get kind of that tunnel vision. And that's a disadvantage because you're not seeing the big picture. That's another way of thinking about it. So, as I said earlier, in a decentralized business, the individual managers are the ones, uh, the individual department or division managers are the ones making decisions. And in doing so, they're creating what we call responsibility centers. A responsibility center is the department that that individual manager oversees. And within that responsibility center, we have this thing called responsibility accounting. And that measures the operational data for that individual department. So when you hear the word responsibility center, think a department or a division. And when you hear the term responsibility accounting, think the accounting for that division, the reporting of the operational data for that division. And within each center, they're responsible for the accounting. And each center has a few other centers within them, if that makes sense. So think of like think of a jar, and inside the jar there are multiple pennies or marbles, and within that jar you have the multiple marbles. Each marble or penny represents a different center that make up the whole center. Which is another way of thinking about this. If a department represents a responsibility center, within that responsibility center are additional types of responsibilities. So, so three primary types. One is called a cost center, obviously responsibility for managing all the costs within that responsibility center. We have profit centers, which are responsible for revenues and costs. And we have investment centers, which have responsibility over revenues, costs, and investments. I know it's confusing, right? How can I put this best? You have divisions and departments. Within a division, you might have multiple departments. If a division manager is responsible for multiple departments, these individual departments are responsibility centers. That means the division managers are responsible for cost, profit, and investment decisions. That's one way of thinking about it. The cost center, in a cost center, a manager is responsible for controlling all costs that are within their scope. There are some aspects of costs that the cost center manager cannot manage. Call those non-manageable costs. A non-manageable cost or non-controllable cost, is a cost that cannot be controlled by an individual manager. That is a cost that is controlled at the highest level of the organization. Examples of that would be fixed assets. Fixed assets are costs that are typically not controlled by the individual manager. That decision is made at a higher level. Does it make sense? Yes, no, maybe. Mostly. Yeah. Okay. Oh, here's a nice, yeah, this is a nice graphic. I like this one. Okay. So your cost centers, you have the entire company. In this example, it's the university. Within the university, we have different colleges. We have the community college, college of business, college of arts and science, college of engineering. And each college has departments. Like for example, college of the community college has a business department, which is where you all are, right? And within the business department, we have smaller departments like accounting, um, management, and within uh, and those individual departments are the cost centers, right? So so this kind of shows how the department goes to the college, goes to the university. That is the makeup of a cost center. Okay. Um, the cost center can be considered the entire college, and the cost center has individual departments that make up the whole cost center, right? I know. Think of it like getting more granular. So, in responsibility accounting, we're responsible for not only managing our costs, but also for the budget. And as you know from looking at our budget chapter and all of our earlier discussions about budgets, we have smaller department budgets that make up the master budget. And I know that we talked about that. We talked about the master budget, and think of the master budget as for the whole company. And then you have your department level budgets. And those budgets added all together make up the master budget. It's the same exact idea. Uh, so when we look at a budget, a master budget, we can break it down into individual departments, and each individual department has its own budget, and we can break that detail down. So if you look at this uh, chart or graph or whatever you want to call this, at the very top, you see the whole company, administration, plant A, plant B. The second budget shows us for plant A, this is just one plant, okay? And it shows us the individual departments for that plant. Department 1, 2, 3, administration. And then the third box shows us Department 1. And it shows us the breakdown for that department. So this shows you how the cost center is developed. Cost center could be the whole, the cost center is the department. Within the department, we have other cost centers. The idea behind it is the individual cost centers make up the whole company. It's interesting. It's very interesting. And this is how reports are developed within these cost centers. Is you go from the top level down to the most detailed level, and when you do that, you go from company to plant to department to detail within that department. Those are the levels, right? And of course, the lowest level, being the one closest to the customer, has the most detail. And when we add all these up, we can formulate the budget, the master budget for the company. This kind of just shows us the concept of the cost centers. So the profit center. So we're talking about cost center. Let's talk about profit center. We love profit. That's the whole idea. Make the profit. Profit centers manage both revenue and costs and profits. Revenue and cost and profit. So, as you know, an income statement has revenues and expenses and profit. So, revenue or sales minus cost of goods sold equals gross profit minus operating expenses equals net income. Well, cool, right? Yeah, so if you think about a income statement, it shows us the same data that you'll find on a profit center. The profit center does not include fixed assets. Fixed assets, property, plant, and equipment, those aren't found on the income statement. Those are on the balance sheet. So therefore, that data will not be in the profit center. Profit center is primarily concerned with the income statement. Sales minus cost of goods sold equals gross profit minus operating expenses equals net profit. That's the profit center. Well, everything covered on the income statement is the profit center. So that's a way to think about when you hear profit center, think everything on the income statement. There's a manager responsible for managing the income statement for their department. And that's really the best way to think about it. Revenue minus cost of goods. Revenue minus cost of goods sold equals gross profit minus operating expenses equals operating income, net income. Net income obviously being the profit, right? The net profit. That's the idea. And so the information comes from the income statement within the profit center. There are two more terms related to this. One's called a controllable revenues, and the other's controllable expenses. The word controllable means that the manager of that center or that department can manage or control those revenue and expenses. They're influenced by that person, right? So controllable revenue, that's revenue that can be controlled by the profit center manager. Controllable expenses are costs that can be controlled by the profit center manager. There are controllable costs and uncontrollable costs. Controllable costs are ones that can be controlled at the managerial level. Uncontrollable costs are costs that can only be controlled at the top level or the central level of the company. An example of a controllable cost would be direct labor. That's a controllable cost. Variable overhead. That's a controllable cost. Variable materials. That's a controllable cost. What is not controllable cost would be things like fixed labor or fixed salaries, depreciation expense, other things that are related to fixed assets. Those are non-controllable. They can't be controlled at the center level. Controllable costs include direct operating expenses, like we talked about. There are other costs, as you might think, as it relates to the profit center that are controlled by a central service department. When you hear service department, think internal services. Okay? Internal services would include things like human resources, communications, advertising, transportation, legal, accounting. These are all services for the business. And they are typically housed in what we call a service department. And that service department charges each center for the use of those services. Here's where it gets a little bit more complex. We'll talk about it. So, for the profit center, as I use my services like human resources and payroll and legal and all of the other business services, as I use them, I charge or expense those services to the profit center. And of course, it gets deducted out. We'll talk about that. Service department allocations are assigned to the profit centers based on the usage by each profit center. In other words, let's say in the profit center, the manager for the department within the profit center, they incur some legal expenses for whatever reason. The service department will allocate the cost that that department incurred to their profit center, which is their profit and loss statement, or the income statement. So again, the way to think about a profit center is that you have individual departments within that center. Okay, and as those individual departments operate, they have their own income statements, and they add up to the profit. Does that make sense? Kind of, sort of, mostly. This particular topic's a little wonky sometimes. Good so far? Okay.
Yes, it's good so far.
Awesome. Thank you, Andre. Okay. Disney. I call them Disney. I think they're Disney. Okay. Disney. Walt Disney Company is a diversified entertainment company that has two operating divisions. Well, technically now they have three. They also have a streaming service, but that's new. That's too new for us. Okay. So Disney has theme parks and they have movie production. Okay. Disney operates a theme park in California and in Florida. They also have movie production in California and Florida. Okay. Two different divisions, theme parks and movies. They make movies, they also have theme parks. Those are the Disney's two profit centers. Okay. Here are the revenues and expenses for Disney. The theme park revenue is $6 million. We'll say it's per month. It's probably monthly. For Disney, that's probably monthly. That's good. It's probably weekly for Disney. For the revenue, $6 million for the theme park, and the expenses for the theme park are $2.495 million. For the movie production, the revenues are $2.5 million, and the operating expenses are $405,000. Those are pretty good margins, if you ask me. The operating expenses can contain direct expenses like wages and salaries for the employees. And I'm sure a couple of other things too. Disney departments and their expenses for the year are the following. For the purchasing department, they incurred $400,000 in expenses. The accounting department for payroll incurred $255,000, And the legal department incurred $250,000 for total expenses for the year of $905,000. Add a couple of zeros, and that's the real Disney numbers, right? Just like we learned about in activity-based costing, there is a cost driver associated with each department. These cost drivers allow us to see the connection between the expenses and the respective divisions. So here's how it works. For purchasing, the cost driver for purchasing is the number of purchase requisitions. You guys remember what that is, right? Purchase requisition is one of those purchasing forms that is completed by the department managers when they want to purchase something. So purchasing department, cost drivers, number of purchasing requisitions. For payroll accounting, it's the number of payroll checks issued. And for the legal department, it's the number of hours billed. Those are the cost drivers, just like we learned about in activity-based costing. Now remember, Disney has two divisions, the theme park division and the movie division. So here's how it shook out, okay? For theme parks, the theme parks made 25,000 purchases. They issued 12,000 payroll checks, and they were billed 100 hours from legal, which isn't very many at all. In the movie division made 15,000 purchases, 3,000 payroll checks were issued, and they were billed 900 hours from legal. Something must have happened. Okay, so what do we do first? We add up the respective service usages. So we have 40,000 total purchases, 15,000 payroll checks issued, and 1,000 legal hours billed. Oh, you guessed it. So just like what we did in activity-based costing, and very similarly, the way we figured out the overhead allocation back when we talked about activity-based costing, we utilize a similar approach to find the allocation rate. These are the rates that are used to compute the per unit, right? Per cost. Per cost. Does that sound right? Per cost. Okay, here's how it looks. We take the department expense divided by the total department usage. Department expense divided by department usage. In other words, the total expense divided by the total number of that respective department. So for example, looking at our Disney here, our purchases, we said that our total purchases were 400,000 and that we made 40,000 purchases total. That's $10 per purchase. Okay, that's the cost per purchase. For payroll, we issued $255,000 was the cost to run payroll for the year. We issued 15,000 payroll checks. That's $17 per payroll check. That's the cost per check. Yeah. For legal, we were billed 250,000 for 1,000 hours. That's $250 per hour. That's the cost per hour. Yeah. Which isn't too bad for legal anyway. That payroll check, that's a little high. I don't know what payroll processor they're using, but it's very high. So after we found the uh, the allocation rate, we need to then find the department allocation. So what we do is we take the service usage times the allocation rate. Surface, surface. Service usage times the allocation rate. Surface, surface. Yeah, so that way. Okay. Here's how it works. So, purchasing for the theme park division says that we spent $250,000 in purchase requisitions. How did we find the 250,000? Well, we made 25,000 purchase requisitions for the theme park division. At $10 per purchase requisition, that's our usage rate, 25,000 times the $10 per purchase requisition equals 250,000. And we apply the same process to everything else, right? Purchases for the movie division, 15,000 times 10, 150. For payroll, the theme park division issued 12,000 checks at $17 per check. It's 204. Movie division issued 3,000 checks, $17 per check. That's 51. For legal, theme park used 100 hours. 100 hours were billed at 250 per hour. That's 25,000. And for the movie division, 900 hours at $250 per hour. That's 225,000. And then you just add up for each division to get your total support department allocations. So what we just did here is we identified service department charges. We figured out what the requisition rates, or what the allocation rates were, the allocations, and what we did to figure out the total charges were we took the number of units times the unit price. It works the same way, right? Does it make sense? Let's see how we got there.
Yes, it makes sense to me. I'm following
Yes, it
along.
does.
Excellent, excellent, excellent. Yeah, it's just a matter of breaking it down, right? And that's kind of how that works. So in profit center reporting, the manager analyzes and evaluates the operating income. And of course, we compare that operating income over time to the budget. Uh, just as we talked about in the budgeting chapter and in previous chapters, we talked about comparing our actual performance to our budget. And it's important that we do that over time because we don't want to overspend, or we also don't want to underspend. And the same comes in terms of revenue. We try to project revenue based off of the budget, uh, and we need to continue to compare our revenue and our expenses to the budget. And that's a responsibility of the profit center manager. One thing of note, we would never compare the operational performance of one profit center to another. In other words, I'm not going to compare the movie division to the theme park division. I would never do that. I would never make that comparison. Why? Because they're different sizes, they're different products, and they're different customers. You would never compare the sale of one product to another. Why would you do that? It doesn't make sense to do that. It's like, oh, I'm going to compare apples to oranges. Well, this isn't going to work out too well. Think of them as their own profit center, their own mechanism for generating profit. So you never want to compare the two profit centers to each other. It's not useful to do that because they're so different. Okay, as you know, the income statement, what does it look like? Well, these are obviously service businesses, so you're not going to see cost of goods sold because there's no physical product. A theme park and a movie, they're not physical products. They're services. They're service businesses. So you're not going to find any type of inventory for a theme park or for a movie division. So the way that the income statement looks for a service type business is you have revenue minus your operating expenses equals operating income before allocations minus your total support allocations equals your operating income. You can see here, you're like, oh, Dr. B, what about expenses? Well, revenue minus your operating expenses and then minus your other expenses or your support allocations. It's the same thing, right? All this does is it shows us the breakout for supporting services, supporting expenses. Because you know that purchasing, payroll, legal, accounting, they're all expenses. They're all costs. And those costs are associated with the revenue that you earned. So that's why we see them separate here. It's just to analyze that data. So profit center shows sales minus cost of goods sold equals gross profit. If it were a retailer or a manufacturer, you'd see cost of goods sold. But since a theme park and a movie division, they're not selling physical products, there is no cost of goods sold. But normally you'd see sales minus cost of goods sold equals gross profit, and then you would see that's when after that then you would start subtracting operating expenses, and then you would subtract out your service department allocations. But you all know that cost of goods sold always comes right after sales. The third responsibility center we mentioned earlier on is called the investment center. Investment center is responsible for the fixed assets in addition to revenues and expenses. So think of the investment center as the larger component of the organization. And within that center, they are also responsible for the revenues, expenses, and the fixed assets. That's when you hear fixed asset, think investment. So if you think of the statement of cash flows, the statement of cash flows has investing activities as the second activity on the statement of cash flows. First you have operating activities, then investing activities, then financing activities. Investing activities, as you recall, is the purchase or sale of property, plant, and equipment, and the cash the proceeds that comes from that. The same concept applies to an investment center. The investment center, when you hear the word investment, think property, plant, and equipment. It's the same. It's the same. So property, plant, and equipment is, or investment centers is often used in diversified companies and organizations by divisions. So another way to think about it is, let's say you have a major manufacturer, and that manufacturer has different plants that they operate. Within each plant, they might have similar equipment. And so that's how it's diversified, right? Investment center managers are responsible for the revenues and expenses, operating income. So, in other words, they're responsible also for the income statement. But in addition to the income statement, they're also responsible for the property, plant, and equipment, fixed assets. There are two ratios or formulas that I want you to know that I think will be helpful, not just for this the quiz that's coming up, but also for the final exam. There are two ratios. These ratios help managers to understand how well they are utilizing their property, plant, and equipment, and their ability to manage their investments. The first is called the return on the investment, and the second is called residual income. So before we look at that, let's use an example. This company, DataLink, they sell electronic devices to companies. They also help companies to operate their databases. Okay? They provide technical service. Okay, so here's how their company is separated. They have the Northern Division, Central Division, and Southern Division. Yeah, North, Central, South. That's how their company is set up in terms of divisions. Each division generates revenues and expenses. You have division revenues, operating expenses, and then of course their department allocations, and then their net income. ROI, return on investment. This formula really helps managers to best understand how well they are leveraging their operating income. In other words, the operating income, which is similar to net income, tells managers how much they can invest back into the company to purchase property, plant, and equipment. So this formula is probably one of the most used in finance and accounting because this formula helps managers to understand their potential to grow the business. The formula for the return on investment is operating income divided by invested assets. I know, invested assets. That's a different term, right? So invested assets, we're looking at fixed assets and equipment. So let's take a deeper look. The ROI, return on investment, is useful for managers, as I said, to grow the company, to understand how well they're utilizing their assets. Each divisional manager looks at ROI in a few ways. The division managers really aren't as much concerned with growing the company as top-level management is. But the divisional managers are concerned about controlling their revenue, expenses, and their assets. And so we look at ROI at that level as well. ROI, return on investment. The higher the return on the investment, the better. A high ROI, which is pretty much anything above 1, tells managers that they are utilizing their assets in the best way possible to generate income. Think of it like, let's say you own a business and you are making clothing. Okay? You're making clothing. And if your sewing machines are idle, meaning they're not being used, you are not utilizing your assets well. The more your machines are being used, the more income you're generating, right? And from that perspective, you can figure out ROI on a piece of machinery because the investment might be the piece of machinery. That's the example I like to use. So the best way to think about ROI is the higher the return on the investment, the better. And you can use that information to compare individual companies based off their ROI and individual divisions if they wanted to analyze that data. So for our company DataLink, we have the three divisions. We have invested assets, $350,000 for North, $700,000 for the Central, and $500,000 for the South. To find ROI, we again take our operating income divided by our invested assets. So for the Northern Division, we take this 70,000 divided by the 350,000, and we get 20%. It's pretty good. It's really good, actually. But yeah, that's fantastic. I mean, really, anything above, like I said earlier, anything above 1 is considered good. 1 meaning like 10%. In this case, all three divisions did pretty well. The Central Division, 84,000 divided by 700, 12%. Southern Division, 15%. Out of the three, we can see that the Northern Division is utilizing their assets the best. But you might be thinking to yourself, well, Dr. B, look at this. The Central Division had an operating income of 84,000, which means they had the greatest profit. So how could it be that the company with the greatest profit did not have the highest ROI? Well, that's a great question. If you look at how much the Central Division invested in their assets, the 700,000. So they invested more. They also made more, but they invested more. And based off of the ratio, they came in last. What that means is the Central Division might have more equipment, but they're not using all that equipment effectively. Because remember, the concept with ROI, return on investment, is I'm using my assets to generate revenue. And the more effective you are at doing that, the higher your ROI is. So the Northern Division, they spent the least on their assets, and they still were able to generate decent revenue, decent income. So from that perspective, the Northern Division utilized their assets the best. That's why their ROI is high. Does that make sense? Good so far, right? Okay.
Digress with everything, Professor.
Awesome. Thank you, Andre. Appreciate it. Okay. I'm going to throw a formula at you that is probably the most difficult formula that you'll see in accounting. It's called the DuPont formula. We use this formula when we're looking at different factors for products. We use it to analyze the differences for ROI across different divisions and across different products, different product lines. And it basically tells us which products are selling the best, which ones are turning over the best. Turnover means how quickly I'm selling it. The DuPont formula tells me the return on my investment as it relates to profit margin and investment turnover. DuPont is the paint company that was founded, I think in like the 1700s or early 1800s. I think in Virginia, if I'm not mistaken. Or it might be, yeah, I think it's Virginia. Anyway, a long time ago, about 200 some odd years ago, the president at the time of DuPont Company wanted to understand how well his company was performing as they were selling paint and other chemicals, but mostly paint. And what the company did is they created, without knowing it, they kind of pioneered the concept of return on investment, ROI, as it relates to understanding their profit margin and their investment turnover. So the company, DuPont, came up with a DuPont formula. So they looked at profit margin, investment turnover. Profit margin, very important concept, and we did talk about this. I'm confident that we did. Profit margin, as you know, is the ratio of operating income to sales. So sales minus expenses, gross profit, profit margin. Investment turnover is the ratio of sales to invested assets. That one we haven't really talked too much about, but the idea of it is that tells me how quickly I'm turning my assets over. The quicker the better, right? That means, it's basically like saying how quickly am I selling my inventory. So for ROI, using the DuPont method, DuPont formula, ROI is profit margin times investment turnover. Okay, profit margin times investment turnover. Profit margin is operating income divided by sales. Profit margin is operating income divided by sales. Sales, revenue, right? Investment turnover is sales divided by invested assets. Investment turnover is sales divided by invested assets. And as you know, invested assets are the assets, the property, plant, and equipment, right? Fixed assets. So what we do is we take operating income divided by sales times sales divided by invested assets. Think the imaginary brackets. What do you call the not parentheses, the thing, the brackets. Remember the brackets, the PEMDAS, right? Do the brackets first, parentheses first. So imagine an invisible parentheses. So you first do operating income divided by sales. Then you do sales divided by invested assets, and last you multiply the two together. The invisible parentheses. So
Order of operations.
You got that, Padron?
Also, that was like order of operations.
Yes, thank you. I was trying to remember the
Yeah.
term. Exactly.
I was just about to ask you that too.
Yeah, order of operations. Thank you so much. I appreciate you guys bringing that back up. I totally forgot about that, Jean-Vieux. So, Jean-Vieux, yes, order of operations. So you would do order of operations with this formula, but think the invisible parentheses. So do the two divisions first, and then you would multiply those two answers together. Exactly. Order of operations. Thank you. I was trying to remember what that was called. DuPont formula, very helpful for understanding profit margin, investment turnover, helps managers to make decisions, as you would think, as it relates to the profitability in terms of sales dollars. To increase profit, we look at the DuPont formula, and that information helps managers to understand what they need to do to increase their sales dollars, or better yet, how much faster they need to turn over their inventory. So profit margin, investment turnover, and the ROI, return on investment, they're related. They're very closely related. The three formulas, as you know, they're different, the three formulas, but they all tell a similar story. The higher the ROI, the better, as you know. The profit margin, higher the profit margin, the better. Yeah, absolutely. Investment turnover, higher the turnover, the better. What these three things have in common is it helps managers to make decisions based on the utilization of their fixed assets. Using the DuPont formula on our example, we said that DuPont formula, operating income divided by sales times sales divided by invested assets, to get us to our return on our investment. So operating incomes for Northern Division 70,000, sales were 560,000. 70,000 divided by 560 is 12.5%. Then, order of operations, we take sales divided by invested assets. 560,000 divided by 350,000 is 1.6. 12.5% times 1.6 equals 20%. Oh, you're like, oh, wait, Dr. B, that's the same exact number that we got from the earlier return on our investment. Yeah, that's right. The way to think about the DuPont formula is another method of computing the return on the investment. It's actually the oldest method of computing return on investment. And the other way I like to think about it is the DuPont formula helps us as managers to validate that our return on investment calculations are correct. And then, of course, you do the same thing for each division. And yet again, we see that the Northern Division, 20%, Central, 12%, Southern, 15%, tells us that Northern Division is utilizing their assets the best, 20%. So how do we increase the ROI of those other underperforming divisions? We look at the profit margin and investment turnover. If the Northern Division revenues can be increased by another 56,000 by increasing our advertising expense by 385,000. In other words, we're going to run a TV ad and increase our sales. We run a TV ad for 385,000, we increase our sales by 56,000. Well, I don't really know if that's a good decision. Let's find out. Operating income. If we increase our revenue by 56,000 by spending another 385, here's how it looks. 616,000 for total revenue, minus the 385 additional spend, equals 231 before allocations. Allocations of 154 gives us an operating income of 77,000. If we run the DuPont formula, 77,000 divided by 616 in sales gets us 12.5%. We run the sales divided by the total invested assets, we get 1.76. 1.76 is clearly higher than it was before we ran the TV ad. So the TV ad raised our return on our investment by 2%, up to 22%. So the question is, did the TV ad and the increased revenue of 56,000 work out to the company's advantage? Well, the answer is yeah, definitely, because with the increased revenue, even with the increased expense, we were able to utilize our investment, the 385, wisely. So when you see an increase, I guess the moral of that story is when you see an increase of any percentage from what it was before, it's probably worth the investment. So the ROI can be helpful in making those types of decisions. If it's a decision of 2%, and obviously it's going to cost us something, but with the additional expense, if our return on our investment increases, it's worth the investment. That's kind of how we look at things like that. So what does ROI tell us? Well, return on investment means for every percentage of return on investment represents a percentage of sales, right? So 20% ROI is 20 cents on every dollar invested. So an ROI of 20 cents for every dollar, it's pretty good. It's pretty good. A couple of disadvantages with using ROI as a measure of performance is that sometimes a manager might reject a new investment idea that could become profitable for the whole company. In other words, that TV ad that we ran, right? The department only generated $56,000 in revenue. Additionally, for a what did it cost us? $385,000. For a $385,000 spend on a TV ad, we only generated an additional $56,000. Was it worth it? Well, yeah, according to the ROI, we generated an extra 2%. Was it good for the division? Apparently. Was it good for the whole company? Definitely. But the manager of that northern division, they could have said, no, I'm not going to do this. I'm not going to spend that additional because I won't yield as much revenue from my division. But the whole company profited from that. So sometimes we can be blind in those types of decisions. That's a negative to using ROI from that perspective. Okay, so let's talk about this other important concept. IRR. We call this the internal rate of return, IRR. Also known as a minimum acceptable rate of return. Management will typically set a minimum rate of return on any investment. Top management sets that. So, for example, as a manager, I would typically look at an investment opportunity and say, you know what? I'm not going to buy that piece of machinery unless I can, at minimum, get a X percentage return on that investment. And that's very typical. Most companies will set some type of minimum return. On average, it might be 10%. Okay? So this our company is looking to do a new project, an investment, and we currently have a return on our investment of 20%. Our company said, our management said, hey, listen, I'm not going to do any type of investment if I don't get at least 10% out of it. Okay, so based off of the company's calculations, we expect that we'll be able to get a return of 14%. Now, this poses a decision tree, right? Well, my current ROI is 20%. If I do this new project, expected return will be 14%. Well, it's above the IRR of 10%. So, do you do it or not? I mean, it's a good question. We look at things like residual income to help us with that decision based off of the IRR. So residual income, what is it? It's the excess of operating income over the IRR. In other words, it's that additional income. It's the additional income over the operating. That's residual. That's what you call residual. The word residual means additional, right? The minimum IRR is computed by calculating the company's minimum return on the investment by the invested assets. The minimum IRR is set as a factor of cost of financing. So here's how it looks. We take, here's how residual income works. Operating income minus the minimum IRR as a percent of invested assets, right? So if the company said, hey, my minimum IRR is 10%, okay, so the operating income, 70,000 for the Northern Division, minus 35,000. Why 35,000? Well, to find the minimum IRR, we take the invested total assets times the minimum percentage, 10%. So the invested assets times 10%, which is management's IRR, minimum IRR, gets us to 35,000. So operating income minus the 35,000 equals, well, 35,000. So we can see by looking at the Northern, Central, and Southern, the highest residual income comes from the Northern Division. So by using residual income, helps management to identify and consider the minimum acceptable rate of return or return on investment. And this return on the investment, by helping us to identify the minimum through residual income, it incentivizes division managers to operate at their maximum capabilities, because the expectation is that each division will work their best to exceed the minimum return on the investment. So looking at the Northern Division, we have the new product, or the new project. Current rate of return, 20%. The minimum rate of return, 10%. The expected return on a new project, 14%. The 14% exceeds the minimum rate of return of 10. That's good. But the division manager doesn't think so, or might not think so. Current rate of return is 20%. If we do a new project at 14%, the division manager might be like, oh, you know, if we do this, it's going to reduce my current ROI. That may not be true. The division manager thinks so because they only see what happens in that division. But for a whole company, 14% is still higher than the minimum acceptable return. So for the individual division, might not be the best project. But for the whole company, that might be a really good project because it might raise the entire company's ROI, not just the individual, and it might not lower the individual division. So that's where this type of decision making becomes challenging, especially when we're looking at residual income. I mean, I would accept that project because it's above the minimum required return. But the department manager, they might not, because it might reduce the department's rate of return. It's interesting. It's an interesting way of looking at those types of decisions. Let's talk about another concept that's related to decentralized operations. We call it transfer pricing. Think of two plants, okay, for two different countries where we have two different manufacturing facilities. We have Division X and Division Y. When we need to transfer products or services from one division to another, there's a cost incurred with that transfer. We call this a transfer price. Okay. Transfer prices are typically set by either the market price, a negotiated price between the two division managers, or what we call a cost approach. When we set transfer pricing between two different divisions, we think about the two different managers and their motivation to transfer products or services from one division to another. This oftentimes happens when we have one division that has too much of a product and another division that doesn't have enough. Okay. The one that has too much of one product might call the other division and say, hey, listen, I got some excess inventory here that I'd like to transfer to you. And that division manager will go, oh, okay, let's negotiate the price. That's what we call negotiated transfer pricing. Wow, that's really blurry. Okay. So here we have the Eastern and Western Division for Wilson Company. Wilson Company, for those of you who know Wilson, they're the ones that make basketballs, and they also make a lot of other sporting goods products. So Wilson has an Eastern and Western Division, like most companies do here in the United States. Eastern Division sold about $1 million worth of this particular product. Western Division sold $800,000 of a particular product. Together, the company sold $1.8 million. The products incur variable costs in addition to fixed costs, as you know. Variable costs, direct labor, direct materials, factory overhead. Those are your variable costs that go into manufacturing of one product. So let's look at the Eastern Division. We sold 50,000 units at $20 per unit. That's $1 million. For the Eastern Division, we incurred a variable cost of $10 per unit. For the 50,000 units that we sold, it's $500,000. We also incurred $300,000 of fixed expenses. We had total operating expenses of $800,000, so $1 million minus the $800,000 gives us $200,000 of operating income. The Western Division sold 20,000 units at $40 per unit selling price. Their variable expenses were $30 per unit, a little high, times 20,000 units, 600,000, minus 100,000 of fixed expenses, giving them $700,000 total expenses, which means their operating income was only 100,000. Now you see the asterisk. There's an asterisk next to the $30 per unit. Why is that? Why is the variable, if it's the same product, why is the variable cost higher in the Western Division? The reason why it's $20 higher is because it represents materials and the original $10 per unit of conversion expenses. Why did that happen, you might be asking? Is because the Western Division didn't have enough units to sell. The Eastern Division had more than enough. So the Eastern Division transferred some of their inventory to the Western Division for the Western Division to complete completion of those units and then sell them. When that happens, it creates this thing called transfer pricing. And in transfer pricing, as we said earlier, there's three different approaches. One is called the market price approach. So the transfer price is set by the market. Okay, the cost of the raw materials, right? Cost, the market price. So basically, whatever you can buy at an external price is the price that we pay. It's called the market price. It assumes that materials for both the Eastern and Western Division can be purchased from an outside supplier $20 per unit. That's where that $20 additional comes from. So that's the market price, $20 per unit. So $20 plus the original $10 of variable cost gets you to the total variable cost per unit. So the transfer price will be $20 per unit because that's the price that both Eastern and Western Division can pay to an external provider. What about the negotiated price approach? In the negotiated price approach, the two managers get together and then they negotiate a price to transfer the products from the Western to the Eastern Division, or Eastern to the Western Division. In these cases, the division manager pays $20 per unit, which is the market price. And of course, they still have to add in the original $10 per unit to get the total of $30 per unit for the variable cost. Using negotiated pricing, the managers can negotiate between the two of them on a transfer price. Oftentimes, the transfer price is less than the market price. The variable cost per unit is usually less than the transfer price, and the transfer price is usually less than the market price. So this is kind of like the cost structure, right? Variable cost per unit is usually the cheapest method that's making it themselves. The transfer price is usually greater than the variable cost per unit. And the most expensive method is the market price. So
Professor,
yes, go ahead.
I'm sorry, not to interrupt you. I have one question. So if the negotiating price, okay, is there like a minimum like where they start from or
Yeah, so,
like
great question. Yeah, so they typically start at whatever the variable cost is per unit. That's like the minimum.
okay, and okay, that makes sense.
Exactly. And then that usually never goes above the market price. The maximum would be
Okay,
the market price.
okay.
Great question.
Oh,
Absolutely.
that's
Very good. Excellent question. Okay. The Eastern Division has the capability of manufacturing 70,000 units. But they can only hold 50,000 units in their warehouse. So the Eastern Division would likely try to transfer 20,000 units to the Western Division because they, have the ability to reach capacity. So in that, if the Eastern Division transfers to the Western Division, the transfer price of if there's a transfer price of less than $20 per unit, that might incentivize the Western manager to buy it from the Eastern manager. And just as I had said earlier, the $20, if it's less than $20 per unit, it's less than the market price. Just as John Vale and I were talking, I'm sorry, let me go back to that earlier slide. The market price of $20 per unit, if the transfer price is less than $20 per unit, the Western manager would be very incentivized to purchase the additional supply from the Eastern manager. And of course, the lowest price would be the variable cost per unit. Okay. Variable cost per unit is $10. That's the cost of manufacturing, right? Most of the time, they won't transfer it at the lowest price. Once in a while, I guess that happens. But in most cases, that's not the case. They usually negotiate a price in between the $10 and $20. $20 being the market price, $10 being the variable cost. They usually end up somewhere in between, typically, and that's the negotiated price. Why we call it a negotiation. For those of you keeping score. Okay. So it looks like from our example, they reached a negotiation of $15 per unit, which is represented in the $25 per unit for the Western Division in variable cost. It's interesting, it's an interesting concept. So, so how do we get, we saw with this negotiated strategy, the Western Division, they used to have an operating income of 100,000, right? Because they were paying, what was it, like $30 per unit or something like that? So they were able to negotiate that to $25 per unit because the two managers were able to agree on $15 per unit as being the transfer price. So with that $5 per unit savings, the operating income came up 100,000. So to find that, what we do is we take the transfer price minus the variable cost. 15 minus 10 is 5. Times the 20,000 units that were transferred equals $100,000. That $100,000 is the increase in the operating income that we just saw. Isn't that nice? Yeah. So in comparing the two, in comparing the units, we can see that variable cost per unit is like the floor, right? That's the absolute bottom price. The transfer price is typically between the variable cost and the market price. Which is the negotiation. It's kind of fun. Transfer price within the range will increase overall operating income by 200,000. If the transfer price $16 were to increase, it would increase the operating income by $120,000. So forth and so on. Now, of course, the more that transfer price changes in either direction, it's going to have an impact on the overall operating income for that respective division, for those respective divisions. So negotiated pricing gives an incentive to managers because they're able to, of course, negotiate between the variable cost per unit and the market price. That's really that's a good method. Sometimes it might not work that way. So they might use what they call the cost price approach. Cost price is the cost of the respective individual units. Direct materials, direct labor, factory overhead, as you know, make up the total cost of a unit. So direct materials, direct labor, factory overhead, simply adding those three together, give you the variable cost per unit. Having said that, the variable cost plus the fixed cost, they would take those two costs together to equal the cost price approach. It's honestly the most effective way because it doesn't detract or it doesn't take away from, and it doesn't add to the operating income. The cost price approach doesn't take away or add to the operating income when it comes to transfers. It's at cost. So that's what makes it the most appealing, I guess. Okay, so one last thing to talk about when it comes to decentralized operations, and you have all seen this somewhere in your lifetime, franchising. Franchising is a model that companies take where they license products, goods, services, and operating models. An example of a franchise business is McDonald's, or Burger King, or Chick-fil-A, or, oh my goodness, the list goes on. Hundreds of different franchises out there that you've all visited and may not have known that it's a franchise business. Franchise, it gives the right to license and operate under a company's name. Franchisor is the company that is providing their name and their goods and services. What the franchisee is the person that pays the franchisor for the use of the name, the products, and the services. They pay a franchise fee, usually as a percentage of sales, and a base fee, usually, especially when they first start up. In addition, the franchisee typically pays for property, plant, and equipment to set up the business. The franchisor offers advertising, management development, business systems, supplier relationships, pretty much everything. We call this a turnkey operation. Yeah, I'm sure you probably heard, hopefully you already know this stuff from your intro to business course. If you don't, or if you do, this is a refresher. If not, this is new. A franchise model, basically what it is let's say you want to start a McDonald's, okay? You'll go, okay, McDonald's, here's $200,000 for me to use your name for the first, to start it. Then you'll say, okay, McDonald's, I'm going to pay you another $500,000 for the franchise, okay? Now, so you pay an initial franchise fee and then you pay a startup cost. Franchise fee $200,000, startup cost $500,000. Then you're able to then go find a building, rent it out or whatever. And what McDonald's will do is they'll provide you with advertising. They'll show you how to run the business. They'll establish the supplier relationships. They'll take care of all the startup. Okay. Of course, you pay for that through the franchise fees. It's a very standardized model across the United States. It's heavily used in a lot of different businesses. Hilton, another classic example. Those of you in the hospitality industry, there's a lot of franchise hotels out there. Hilton, they franchise out most of their properties. Hyatt does the same thing. They own a few themselves, but they do franchise most of theirs. Marriott, for sure, they do that. There's a bunch of other companies that do it. International Hotel Group, they're the ones that own all of the, or they do the Holiday Inns and Best Westerns and the gamut, right? Most hotel operations are franchise businesses. They're owned by a local company or a local family that pay, and they pay the franchise fee to whatever flag they're flying under. And then that flag, they provide all of the advertising and all of the operation concepts, the PMS system, right? They provide the revenue management system, the PMS system. They even provide room key cards, right? Linens, you name it. They provide the resources for all of that, but you, the owner of that hotel, you pay the franchise fee and you pay for all the expenses, of course. The benefit to franchises is that it gives you the name recognition. And that's why people stay at those types of hotels, because they know the name. Okay, so here's an example. Revenue, operating expenses, general administrative expenses, property, plant, and equipment. Company operated, that means the company owns it, and then there's franchised operated. We can see major differences, right? In a franchise model, they typically pay a percentage of sales. And you can use the ROI DuPont formula to understand if your investment into a franchise is worth it. Operating income divided by revenues times revenues divided by invested assets. Revenues is sales, right? Revenues is sales. And so running that formula, you can identify whether opening a franchise is worth the investment. That's another classic example of using the DuPont formula. And there it is for the franchise hotels. So it's interesting. It's interesting stuff. Okay, that is the end of our presentation for today on decentralized operations and analyzing them. Any comments, questions, concerns? Anything that we didn't cover that you hope we would?
Yeah, we definitely covered a lot today, but I definitely took it all in. I'm in the hospitality industry, and I didn't
Right.
look. I looked at the franchise. I know about it, but I haven't looked at it in an accounting perspective. So this looks really different for me.
Right.
But I'm definitely, I'm definitely intrigued.
Yeah, that's a great comment. Yeah, if before you ever decide to get into a franchise type business, or actually for any business for that matter, if you're let's say you have a catering business, and in your catering business, you're like, oh, I'm thinking about buying this new freezer. I don't know if this new freezer is going to work out. It's kind of expensive. What I would recommend that you do is run the ROI, the return on the investment of that new freezer. You're starting a franchise model. Run the ROI on the investment. The ROI, it's not just for a business. It can be for a personal decision. It's like, oh, I want to buy that new car. That new car has cost me X, and Is it worth it? Well, the car will be your invested asset, right? Operating income is your personal net income. The revenues would be revenues if you're planning on using the car for Uber or whatever. You can even do it for that type of decision making. But the concept applies to a lot of different things.
Yeah, I see that. I definitely see that now. I definitely see.
Yeah,
Thank
it's a
you,
great tool.
Professor.
Absolutely.
Yeah.
Good comment. Um, any other comments, questions, concerns? We're good. Okay. So as a reminder, what's going on? If you could believe it or not, we're in week 12. I know, right? It's crazy how quick time goes by. What's going on week 12? Chapter 24 quiz. Just like before, just like your other quizzes, it's relatively straightforward. At 5 questions. Take your time. You got 2 tries. Um, yeah, we're looking good. Week 13 next week, we got a discussion board. Remember, the discussion boards are super important. They're worth 5% of your total grade. Don't lose half a letter grade by not doing it. That's not good decision making. You want to do it. Try to earn some points. Okay? Don't fail the class because you didn't do the discussions. You could easily fail this class by not doing the discussions. Do the discussions. Please do the discussions. I'm begging you. Don't fail because you didn't do the discussions. Okay, so week 12, chapter 24 quiz. Next week we have chapter 25 discussion. Then, and I'm trying to prepare you for the future now. Here we go. Week 14, so it's 2 weeks from today. 2 weeks from today, chapter 26 quiz. 3 weeks from today, we got 2 chapters. That's going to be a long night. Okay? Why a long night? Oh, Dr. B, what are you trying to do to us? I know. We got 28 chapters to cover. I can't go do week 16 because week 16 is your final exam. Okay. The last day of this class is April 24th. For those of you keeping score, that's 26 days from now. Okay, we have less than a month. So, my recommendation to you is work ahead, work often. It will help you in the long run, I promise. So, hopefully that helps. If you think of anything else, you let me know. If the drill, go ahead.
Uh, for the people that are graduating, do we have to turn it in earlier?
So happy you asked that question. For those of you who are graduating, do you have to turn it in earlier? Let's take a look. Academic calendar. The week of finals for graduating individuals is, where is it? I'm sure I passed it, didn't I? Where is it? I know it's around here. It is. Yes, by one day. What that means, the drone, is for those of you who are graduating, and I have a list of those of you who are graduating, you will have to also take the final exam during that week. I know it's a lot. It's like, oh, I got 2 chapters and a final exam to be done all by the 24th. Yeah. Because then I have to have your final grades in, that's why. Yeah. Yeah. So that's the plan for drone. For those of you who are graduating, you'll have the chapters 27, 28, and the final on that same week. It's heavy duty week, I know, I'm sorry, but that's kind of how it shook out. Does that help you to answer your question?
Yeah, thank you. Appreciate it.
Absolutely, great. Any other comments, questions, concerns? Okay, wonderful. If you think of anything, just let me know. I'm here to help you. Anytime you need me, call me, email me, set up office hours. You know how to get me. I've been here for you guys, and I'll keep being here for you guys now until the end of time. Great. Okay. Stay safe. Wash your hands. Do the right things. Thank you all so much for your time today. And I'll see you again. Same time, same channel. Take care, y'all. Have a
Thank you. Have a great evening.
Thank you. You too. Take care.
Thank you. Have a good evening.
Bye-bye.
Professor.
Bye.
Good night. Good night. Take care, y'all.